Well, hello everyone, and welcome back to another Southern California housing market update. My name is Steve Meade with Domicile Real Estate. It is still a little chilly today, so we are rocking the fleece hoodie. Want to talk a little bit about the new year and what's happening. And sometimes you can get these things that we call mixed signals, right? Where what you don't understand is something a growing trend, or is it just an aberration in the data that's in one set of the data that we've looked at? And I think that's probably one of the hardest things, right, to recognize in these data sets, is to kind of understand that. So we're going to go through and I'm going to talk about what the numbers are showing, and then tell you some of the ways that could be interpreted, right, and try to paint sort of an overall picture of what's going on in our market. And as usual, we've got some good news as well this week. So here's the first thing we're going to talk about is our total active listings. And I want to talk about this because both in our under 1 million and in our $1 to $2 million price segments, we saw that total active listings went up by a small amount, and is definitely up over where we were a year ago in terms of inventory, but still well below where we were at the crest over the summer and through the fall. And what happens around the holidays, right? Like, what happens around this time period is that we see generally people sort of start pushing these listings to the new year, and then we round in the first 2 weeks of the new year and we see this number bump up. So I want to tell you something though too that I want you to remember, and that is total active listings is really sort of the result of the net difference, right, between homes that came onto the market and homes that have left the market. So if 10 homes came on the market and 10 homes went into escrow, your total active inventory would be exactly flat, right? So the fact that this went up means that more homes came onto the market than went into escrow. But it's also important to note, this is the 3rd of January through today. So, that's not exactly known either as the most active time for buyers, right? Because a lot of these homes came on the market in that first week into January. Buyers really haven't had a chance necessarily to see a lot of those houses. So bear that in mind, that might actually play a little bit of a part in this number. And to see, we usually see a bit of this hockey stick-like shape in inventory year over year, though you'll notice here, it flattened out from this point forward. So I'm kind of curious to see whether we're going to see a flat and a slow rise through the spring, like we did last year, or whether we will see something else. This one tells kind of an interesting story, right? And remember, I just mentioned we were talking about that hockey stick. This is the new listings that have come on the market in the last 14 days. So this is just what's happened with new listings coming on. And you see, right, listing activity just kind of tapers off through the fall, and then just really kind of through November and December just kind of craters until it hits kind of rock bottom that week between Christmas and New Year's. But look at where we're at right now. I mean, under $1 million, this is a huge jump. Same thing over here for our $1 to $2 million, right? And I think on the face of it, you might be inclined to conclude that the market has just done an about face. It is slow, inventory galore. But I want to point something out to you very quickly here that I think is really important to understand when you are looking at this chart. So we're going to do this right now for our under 1 million category. So if you look here, this is right before Christmas, right? I think the 20th. And then you look on the 3rd of January, right? That is the slowest week in real estate in just about any locale in North America. And you see this number, how it came down, and then you see that it shot up. Now, if you take the distance from here to here, and if you flip that over, you actually get to pretty close to where we are here. So same thing if you look down here, and in fact, it may have not even rebounded by the amount we were down. What this tells me is that this is not the sign of some new huge jump in inventory, right? What this is really us making up for the listings that people were going to put on the market over those holiday weeks and just didn't. Well, they held off on them. These numbers were lower, these numbers are higher. Maybe there's a little bit of a rise in the new year, here for our under 1 million, but we didn't even make up our loss here, really, I think, on our 1 to 2 million, meaning that price range definitely has fewer homes in it. Now, remember, buyers can't buy houses that they haven't seen yet. So there's kind of a natural delay, right? If you put a home on the market on a Monday, it will probably be a week before it goes under contract, even in a very busy market. So if we look at our new escrows, what do we notice here in the last 2 weeks? Again, we had a pretty big drop and a bit of a rebound, right? A bit of a rebound, not quite where we were on the 20th, but coming back up. This demand is actually a little weaker than I expected. So definitely, we're going to want to watch this, right? How much is this going to rebound? Because look at what we had happening last year. I mean, we were in a pretty strong rebound mode at the beginning of last year. I want to see two things. One, is this new listing level going to hold, or is this going to flatten out? And is this going to stay like this, or is this going to rebound further into these new escrows? So definitely a space to keep an eye on, because I think that's really going to tell us what the kind of first quarter of the year is going to look like. Now, if you look at our absorption rate, right, what happened is all these right here before the end of the year, what did we see? Well, our absorption rate went through the roof because buyers were still buying at a slower pace and nobody was putting homes on the market. What's happened now? An influx of new listings come to the market. We see this absorption rate drop to a little below 70% here for our under 1 million, and gosh, right around 50% for our 1 to 2 million. I think, again, this is kind of a pendulum effect. It swings up and now it swings down. I think we're going to see this number normalize back out in the same zone that we're seeing. If we don't, that will actually say something about the market. If we don't end up in this kind of 70% to 80, 90% range, that will tell me that something is definitely up. And, you know, it's funny, if you look at this, right, you can see these little places where we dipped, and these were low points in the market. Excuse me. Now, if we look at closed prices, again, this is taking a look in that rear view mirror. And, you know, what do I see? So I'm going to start from the bottom of the market this time. I actually see a pretty flat market here, maybe a very, very gentle downslope. You know, definitely we had some big drops maybe from our little high points here in that kind of like May, June timeframe. But it's really kind of flattened out. Same thing on this median point here, right? Our median was high, and then it really precipitously has kind of dipped down, but at a very, very slow rate. Our 75th percentile homes, these are those top-end homes above $1.25 million. And what do we see happen here? I mean, this is far more erratic, partly because we have fewer listings, right? But also that top end of the market covers an extreme of the market, right? So a $10 million home, if there's a bunch of people sell those ultra mega buck properties, that will affect this number. You know, we see kind of a rebounding in price that occurred here, but the reality is this one has probably jumped more as a percentage than the other two. If we look at our percent still active after 14 days on the market, this one is very interesting, right? And that is, this number is starting to drop. And this actually indicates a more competitive market, which is kind of more evidence that when we looked back here and saw this rise in new listings, that this isn't exactly what it looks like. If we come here and looking at our close or list ratio, we're right around 98% for both of these. We dipped and then bounced back up. This is sellers really coming to terms with the fact that their home may not be worth what they thought it was. And, you know, there's really two effects going on here. I think most people think that the majority of this effect is based on the market being softer. And while that's true, it's not softer necessarily in the way you think. And that is, not every home is treated the same way in this market. We talked about this before. These homes that are at the top levels of desirability, top 20% homes, we'll call them, they have experienced a much lower loss of demand than those homes in that bottom 50th percentile. So again, you know, this really is your mileage may vary. Do not think that that home that just came on the market with those beautiful photos immediately means you should offer 2% under list price if it is priced right. it will still go for close to that list price number. This is another little fun piece of information here, right? And that is, really, as soon as we came out of that May time period, June time period, we started seeing our days on market for new contracts rise. So again, these are the homes that are going into escrow. How long were they had for days on market before they received their offers? If we look at that, we saw this number really kind of take a rise, and it really jumped towards the end of the year. It has crested and has begun to fall. That is a similar trend to what we saw last year, though I would argue that this rate of decline is especially steep. What I'm curious is, where is this going to flatten out again? How much higher is it going to flatten out than it did last year? Last year, our low point in days on market was under 20 days. My guess is that we're going to be somewhere in this 30 to 40 day range, which really is a far more normal market. Now we have the three-way chart. And just as a reminder for everyone, I'm a big fan of this three-way chart because I think this really tells you about the relationship to buying and renting. So our blue line is the payment index. We've indexed these all to June 2018, so we can watch how they have changed. Payment index is it's based on the payment on a median priced home at prevailing interest rates. So we see, this number is actually a bit lower than it was, even towards the end of April, May. We're actually in a better spot than we were then, definitely better spot than we were through June, but still a little bit higher than we were in August. And obviously we are higher than we were back at the beginning of 2022. If we look at our rents, we saw those took a jump by a delay, and then those rents have been soft. And I think what we're seeing in this is we're seeing a number of home sellers, of would-be sellers, have decided to rent out their homes. That has increased rental supply. And it's generally led to sort of a softening of these rent prices, not necessarily by a huge amount, by enough to be noticeable. And what I love to track here is this graph, right? Now, another thing that I'm finding kind of fascinating is if we look at our CPI index here, we see that rents kind of took off, right, well beyond the CPI. And what's happened is that CPI has been going up, though it actually declined slightly for the month of December. This has brought this not that far in line. Like, these are very sustainable rent levels, in my opinion. My thesis is that in the long run, housing will go up in price faster than CPI. Why will that happen? Because we have a scarcity and a shortage of housing. We do not have enough units. That means that the price of housing will go up faster than inflation in the long run. That's my thesis. I'm sticking to it. And this gap really is something that we track quite a bit. And, I feel like what makes this number move? Well, this number is affected by two things: interest rates and prices. So if you want this blue line, right, to go down, it's going to have to either be interest rates or prices. We actually have seen prices overall have come down a little bit from this sort of like high point period in April. They have come down a little bit. Interest rates obviously have gone up quite a bit. Everyone loves to play this interest rate guessing game. The sort of common word on the street is that they will continue to go up through 2023 until towards the end of the year, at which point they will level off and possibly decline. That's the story everybody's going, but at this point, just given how uncertain some of these things are, I think it's foolish to sort of base your plans on a particular course of action from interest rates. So, what can make this number change? We actually saw the rents kind of bottomed out and came back a little bit. I think we're going to see that rent amount stabilize a bit here. And this gap is not huge, right? Like, this is not that dissimilar from gaps we saw here. And it's definitely smaller than these gaps that we saw here, which were really, really too wide. I'd still like to see this number get a little closer. And I think it's even money. Is this going to be home prices, or is this going to be rentals, or is this going to be interest rates to kind of bring these lines closer together? Finally, we do have our prevailing mortgage rates chart here. You saw that we peaked and just kissed 7% on a national weekly survey, and we've kind of come down a little bit from there. A lot of economists think that 5.5% is this magic number for demand in the housing market. I'm not quite so inclined to believe in those kind of magic numbers. I do think dropping below 6 will have a psychological impact for buyers, but we're just going to have to wait and see. We go here. So that's all I've got for you guys this week. As always, questions, comments, we love them. If you are looking to buy or sell residential real estate in Orange County, especially architectural homes, or if you're a first-time home buyer, we would love to hear from you. Do not forget to like, subscribe, and hit that notification bell. And as always, questions and comments, we love them. We will see you again real soon.